Nick Elder with Ironton Capital. I'm joined here. I'm here with Jeff Minnick with Directed IRA, where to park your cash in volatile times. The real estate market is, going through a lot of ups and downs right now. The stock market has become, more volatile than it's ever been. So we're going to educate you guys on how you can deploy your capital into some short and medium term options. And at the end of the presentation, we're going to tie this into how you can do that with your self-directed IRA, which Jeff is going to give you a lot of great information as far as that goes, and get right into the note from our attorney. So you're going to get some questions here, or you're going to see some things here, some forward-looking statements, some projections, such as, will, should, expect, plan, anticipate. Please understand any projections that you see, especially as we go through the case study that I'll present to you guys, they're all based on, they're all forward-looking statements based off our own underwriting analysis and projections and financial modeling with our investment committee. So please understand that any investment in any fund involves high risk, whether you're investing in the stock market, you're investing in real estate, or any other alternative investments. Please understand there is a certain degree of risk associated with it. Nothing in here is an offering of investment opportunity. If at any point you are interested in learning more about our funds, you'll review our subscription legal documents, at which point you will be presented with the official offering of investment opportunity. And please make sure that you're always involving, whoever's involved in your decision-making process, investment decision-making process, whether that's your CPA, attorney, spouse, whomever that may be, financial advisor. It's really important that you get all of them looped into your decision-making when that time comes. So one more thing I want to mention before we dive in, there's a chat box on the right-hand side. So we like to keep this engaging. As we move through the presentation, please feel free to send over your questions. We'll address them as we go. So we like to try to keep this interactive, and we'd love to see if you could type in where you're joining from. We'd love to kind of kick up the interaction here and see where you're all tuning in from. So a quick overview of Ironton Capital before we jump in. The investment team is comprised of our founder, Lon Welsh. Some of you may know who he is. Lon spent close to a decade in strategy consulting, working for some of the big firms, spent 20 plus years in commercial real estate acquisition and development, and built the largest independent Colorado brokerage in Colorado, and sold to a private equity company in 2021 alongside his first Alliance Title company as well. Richard Landry, he's our chief investment officer and also one of the general partners. He's held a number of executive level positions, being a CIO or chief investment officer at a large family office firm, also chief financial officer of another private equity firm before joining Ironton. So he's got a ton of experience in investment banking, also worked in Goldman Sachs too. So he's got Wall Street experience in doing a lot of the analysis that's done at various Wall Street firms. And then Brent Geyer, he spent several decades in real estate acquisition and development. Obviously manages his own portfolio too. He's done over $1 billion in transactions during his time at Centex Homes, IntraWest, and before then he was in accounting and worked for KPMG where he started his career. So point being, we got three guys that are very well versed in making investment decisions. They've got a ton of experience combined. They've got 50 plus years of experience in the investment world. So all right, let's dive into the presentation. So where to park your cash. So the point that we want to get, or what we really want to dive into here, guys, is where are some safe ways to park your cash, your liquid cash, again, whether that's in your IRA or just cash that's in a bank account, whatever that may be. So there's really two ways to think about it. There's short, medium term. There's a third way, it's long term, but we're going to focus really on just short term and medium term. One way to do that short term is, many of you might be familiar with a high yield savings account. There's really two ways to do it. There's a high yield savings account option, and there's a certificate of deposit. High yield savings account options, especially with interest rates, they've spiked since 2022. So that's really opened up the opportunity for you to park your cash in some short term options, such as the four ones presented here. There's many others. A lot of your banks offer it, but today's high yield savings rates are about 4 to 4.5% annualized. So pretty good. I mean, it's risk-free. Your banks offer, and they often want you to bring in more cash. It's not necessarily cash you already have there. They want you to bring in more money so you could qualify for the rate, but it's risk-free, typically FDIC insured. That's a great way to park some of your short-term cash. Maybe that's 3 to 6 months or whatever your liquidity needs are, it's a great option. Now, going to jump ahead here and then take a slide back. The other option is a certificate deposit. So unlike a high yield savings account, a certificate deposit, it might pay a little bit higher, but what's different is that you are required to a certain lockup period. Now, typically that might range from 6 months, 12 months, 18 months, 2 years. Your bank will offer many different options there. It's going to pay a little bit higher than a high yield savings account, but you are obligated to a certain liquidity lockup. And if you seek or you want to take that money out ahead of time, you will be obligated to pay a penalty, in which case it could negate all that interest that you earn. So really there's two main options. Like I said, the high yield savings account, highly liquid, today paying about 4 to 4.25. Certificate deposits, not as liquid. There's set maturity dates like 6 months, 12 months, typically paying at today's rates about 4.25 to 4.5%. Both are for the most part risk-free, and as a result, you're getting a much lower rate of return. Now, I want you guys to really think about some things differently here. So one other thing with the high yield savings account certificate deposits is they really thrive in high interest rate environments. Now, over time, it's likely that the Fed will continue to will lower interest rates likely over the next 3 to 5 years, I hope at least. And as they do, typically banks, they'll charge less on your high yield savings account. So the 4 to 4.5%, that'll likely follow the Fed's decision. So those rates will come down over time as well. So now all of a sudden your risk-free rate of return is more like maybe it's 2 to 2.5%. There's another option, one that Ironton Capital offers, and it's a short-term income fund. There's a lot of other funds that offer similar opportunities, but our short-term income fund offers about 8 to 9% annualized rate of return. Dividends are paid quarterly. It is a relatively fast liquidity, and there's no required lockup period, so you're not penalized for withdrawing money quicker. It does take a little bit longer to get your money out, whereas a high yield savings account, you can pull it out and probably have it available in a couple of days. Short-term income fund, we always ask for a 30-day notice, but it's a great opportunity for you to easily double your rate of return in an asset with strong collateral and a strong track record. The short-term income fund is primarily real estate, and then we have a component that's medical receivables. It's also taxed at a lower tax rate. So our short-term income fund has REIT designation status, meaning that it's taxed at the 20% federal level. So if you are maybe you're a physician or attorney or any other high income earning professional and your tax rate is above 30%, this would be a tax advantageous route for you to park some of your cash versus being in a high yield savings account or a certificate deposit. Now, when we do a model over about a 10-year period, we're assuming in this case that you are reinvesting all of your distributions, which is an option in both of the funds. So pre-tax return, I know we just said it was 4%. We did use 3% in this analysis. The 4% wouldn't be too far off. But we're looking at pre-tax return across a high yield savings account or a certificate deposit at 3%, and we're comparing that to the 8% short-term income fund option. We're also looking at an income tax rate, right? So we want to look at this from an after-tax standpoint. Now, we're not looking at this from an inflation-adjusted standpoint, but you could probably run your own math there. Simply from a tax standpoint, the high-yield savings account or certificate deposit will be taxed at your income tax rate. In this case, on the upper end, it might be 39%. Whereas that same investment made in the short-term income fund at an 8% pre-tax rate, but taxed at 43%, has a much larger differential between the much smaller differential between pre-tax and after-tax. So really we want to look at this from an after-tax standpoint. If you had your money in the high-yield savings account, your after-tax return would be around 1.83. If you were in the short-term income fund, your after-tax would be about 6% annualized. So we compare that over a 10-year period, you can see that just simply because you're compounding at a higher rate of return, you end up about $62,000 ahead than if you just had your money parked in the in the high yield savings account. Now, one thing to consider too, inflation, you can obviously expect to be about 2 to 3% a year. Lately, it's been maybe closer to 3.5%, 4%. So when you even factor that in, it's likely you're just keeping on par in the high yield savings account, but you're still coming out ahead in the short-term income fund. But overall, we have about a $62,000 difference compared to the high yield savings account and the short-term income fund. Now, what if you were willing to lock your capital up for a little bit longer? Maybe you're okay with being in a fund for a little bit longer than a year. or less, whatever the case may be, we have a medium-term income fund option. So our medium-term income fund delivers an 11 to 13% annual fixed rate of return. Dividends are paid quarterly, just like the short-term income fund. There is some liquidity. We only ask for a 1-year lockup on that capital. Anything beyond that, you're able to get your capital out so long as you satisfy the 1-year lockup. Now, a lot of us right now, we have a lot of exposure to the stock market. We probably have some exposure to the real estate market. We also know, right, that the real estate market is heavily influenced by the interest rates in the economy at the time. Stock market, very influenced by that as well, but has been so even more volatile as just accessibility into the stock market has gone up. What's great about the medium-term income fund is that it's uncorrelated with the performance of either the real estate market or the stock market. And that's because we're invested in medical accounts receivables. So we're going to do a quick comparison here. This is a comparison we do with a lot of investors. In this case, we had an investor come to us with 2 properties, and they were wanting to know if they wanted to sell their properties. They wanted to see, hey, look, I'm considering selling my properties, but I don't know what to do with the cash afterward. And I want to better understand the rate of return that I'm getting now and what I could expect over the next 5 to 10 years of owning this asset. But what if I sold today, reallocated some of that capital? What would that look like over 5 to 10 years? And so we ran that analysis with this investor. In this case, they have 1 property in Denver that is worth about $500,000. They've got another property that is $925,000 with only $110,000 in total debt across the properties. Now, if they sell, what we do in the analysis is if they sell, they're going to obviously pay sales costs. In this case, this investor was also an agent, so they're going to sell their own property. We're assuming 3% appreciation of the current property and 3.7% cash flow. So in a do nothing scenario, if they kept the properties, they're going to compound annually at about 7%, which is factoring in the appreciation in cash flow. Now, if they were to sell it, there's an option for them to roll the funds, take the cash, and invest in one of our 2 products that we have shown here. So in the do nothing scenario, we're seeing 6.95% or 7% compounds over a 5 to 10 year period. So in this case, they decide to keep the property. They're not going to sell it, and they're going to see how the equity rolls over a 5 to 10 year time horizon. So in 5 years, their $1.3 million comes to about $1.84 million. And then in 10 years, that compounds to about $2,575,000. Now, what if they were to sell and invest in the medium-term income fund and park their cash there? If they were to do that, the equity in their old rentals is $1.3 million. Now they're going to incur transaction costs, and they're going to pay a capital gains tax from their original basis. So the amount they have left over to invest is about $300,000 less than the equity that they have compounding at 7% if they were to just keep the property. So as a result, they're getting about double the rate of return, a little less than that. So 12% compounded over 5 to 10 years. We see in 5 years, they're still kind of catching up. They're about $100,000 less than the equity in their do nothing scenario. But in 10 years, we start to really see the impact of the 12% compounding in years 6 through 10. So in years 6 through 10, by the end of year 10, when we compare to the do nothing scenario, in the do nothing scenario, their equity builds to $2.5 million. If they sell and invest in the medium term income fund, their equity compounds to about $3.1 million. Now, of course, we like to compare in the stock market as well. Even in that scenario, if you're in a typical 60-40 stock bond mix, and we look at the returns historically in the stock market, they could put the money in there. They're still going to incur transaction costs and cap gains taxes. They're going to have the same amount to invest as they did in the medium-term income fund, except they're earning 400 basis points less. So over 10 years, they come out at about $2.18 million. So they're still better to be in the do nothing scenario and keep the properties, but there's about a $500,000 advantage for them selling and going into the medium-term income fund over a 10-year time horizon. So we really see what the effects of compounding at a higher rate of return are over a longer time horizon, and in this case, 10 years. So that's everything that I got on my end. I want to give the show over to Jeff. The main point here, guys, is that what I think is really attractive about from an IRA standpoint is that you're either in a tax deferred account or you're in a tax free account, whether that's a traditional IRA or a Roth IRA or any other. Why that's important is in the model we just modeled out, that was somebody selling a rental property, but in a tax deferred or tax-free account, especially tax-free, that 11 to 12% that you're compounding every year just continues to compound at that rate of return every single year. So we have a lot of our investors that rather than taking the distributions each quarter, they elect to reinvest those distributions through their IRA, and now they don't have to think about how to redeploy the quarterly distribution. So Jeff's going to go into what does it look like setting up an account with directed IRA. We're going to have some, questions as we move throughout the presentation. So Jeff, before turning it over to you, I'm going to answer Robert's question here. So with the shorter medium-term fund, is it possible to lose your principal investment? Moreover, are returns guaranteed in the range shown? So I'm going to go back. Let me go back to this slide. Like any investment, Robert, I mean, there's a possibility of losing your cash, your principal. I mean, you could be in the stock market, you could own your own real estate portfolio. There's always the risk of losing your capital. So what I like to do is I like to point to what is the track record of the fund, because I think that speaks to the risk overall and the likelihood of any potential principal investment loss. So in the case of our medium-term income fund, we partnered up with a sponsor that's been in this space since 2016. Since then, there's been, as the markets have gone up and down, real estate has gone up and down as well. But since 2016, there's been zero capital loss, zero missed quarterly payments, and it's performed right within the 11 to 12% rate of return every single year. So past results don't guarantee future success. No returns are ever guaranteed. Of course, I'm always happy to have a conversation with someone if you want to, go through what are the risks of the investment. But overall, when we look at about a 10-year track record, there have been no loss of principal. There have been no missed quarterly payments, and we've hit that return range every single year. Now, in the short-term income fund, there's more exposure to the Denver residential real estate market. So while we've seen a little bit, performance can go up or down, just depending on how the Denver residential market's performing, because it is by nature a hard money loan fund. Though we've seen a little bit of, we've seen some staggering performance over the years as the Denver market has softened a little bit, but there's never been any capital loss in the fund. But returns do oscillate between the 8 to 9% a year. It's a good question. All right, Jeff, I'm going to turn it over to you. Tell us about directed IRA. Tell us about yourself, and then tell us about directed IRA and what some options there are out there for investors.
Yeah, thanks, Nick. Appreciate it, and happy to jump in here. So I've been working in the self-directed IRA space for 14 plus years now. I worked for some of the largest competitors in the space, and was happy to join Matt Sorensen and Mark Kohler and the team here at Directed IRA. The reason being, Matt Sorensen actually was the one that trained me and taught me everything I know about the self-directed space. He actually wrote the self-directed IRA handbook. So this was the first material I ever received when I was starting to learn about self-directed IRA accounts. And he's now on his third edition, just came out about a month ago. So for anyone that's listened to this presentation and wants a deep dive into self-directed accounts or wants to learn more, you can go to Amazon, pick up this book. It really is the guidebook to self-direct your own retirement account. It's got all the case law in there as well. Like I said, Matt is an attorney that founded Directed IRA. So this is a deep dive, a must-have book if you're going to self-direct your own retirement account. But working in this space here, again, I'm our vice president of business development. I work with a lot of our relationships. So I'm the primary point of contact for Ironton Capital investors. Anyone that wants to invest with Ironton Capital using their retirement account, you're going to speak with me about setting up your account, getting it funded, getting it invested. So happy to work with anyone here, and help them get started. The self-directed IRA space, it's somewhat niche. There's not many people when I talk about what I do for a living that truly understand kind of my role. And I think it's because only 2% of Americans self-direct their retirement account. It's just not something that your financial advisor is likely going to tell you about. Because they don't offer the types of investments that we do. So I'd love to really kind of just dive in here and just kind of explain what a self-directed IRA account is. And I think that'll help. There's no retirement 101 class that they teach you while you're in school. It's basically, up to you or a mentor that you have to hopefully teach you about traditional IRAs versus Roth IRAs, how to save in your 401k plan. So that's really the part of my job that I really enjoy, is I get to help educate people about this topic that they may or may not know quite a bit about. I know retirement accounts, super exciting, can be kind of dry, but when you're talking about building wealth tax-free, like in a Roth IRA, like you were referencing earlier, it's a pretty powerful tool. So, I would say if you're not learning about this, you're kind of doing yourself a disservice, especially if you're an investor. Take advantage of some of these accounts. They can be extremely powerful tools. I'll give my little disclaimer here. Directed IRA, founded by tax attorneys. So again, have to read this slide. All the information I'm going to present here, it's for educational purposes. If you're considering an investment, please consult with your tax professional, other counsel, other attorneys, or financial professionals that can help you with your due diligence and help you make good decisions. Now, with that out of the way, what am I going to be covering today? I'm going to talk about what a self-directed account is, how it differs from your brokerage IRA that you may have at Fidelity or Schwab or Vanguard. I'm going to go over the different types of accounts you can self-direct. And then I'll also go over what are some of the benefits of investing in private funds, like the short or medium-term fund that you were just referencing. What are the benefits of owning that in your IRA account? And then lastly, I'll just cover how to get started here. Ever since the mid-1970s, your retirement plan can own almost anything. There are a few things that the IRS has told us you cannot hold in your IRA. It includes certain collectibles like alcoholic beverages or firearms, S corporation stock, and life insurance contracts. Outside of that, it's pretty much fair game. Now, there are some rules you have to follow against self-dealing and things like that, but you can get really creative when you're investing with your IRA. If you happen to talk with a company like Fidelity, they may say, well, we have a self-directed IRA option. I always tell clients that self-directed describes the investing you're doing. You are picking your own investments. You're doing your own due diligence. So Fidelity does have a self-directed IRA. But when your account is custodied there, you have to pick from their menu of investment options. Fidelity holds publicly traded assets. So stocks, bonds, mutual funds, ETFs, certificates of deposit, CDs like you were talking about. Those are all the menu options at Fidelity. By moving that account, though, to a custodian like Directed IRA, you can still make all of those same publicly traded investments, but now you're going to open up the door to being able to do all the private or alternative investments. So that's where private funds, private companies, or private equity investments, real estate, cryptocurrency, precious metals, private lending, these are the types of investments that our clients are utilizing to grow wealth in that tax sheltered environment of their retirement account. You may have heard of Peter Thiel having a $5 billion Roth IRA. He didn't grow that account sitting at Fidelity investing in the S&P 500. He invested in PayPal pre-IPO when it was a private company, and then many others along the way to build that kind of significant wealth. Wealth that's actually being challenged. There's some legislation where people are trying to limit the amount that you can grow in your retirement account. So nothing passed over to law yet, but just something to keep an eye on, something that we're always monitoring here.
Awesome. Jeff, got a quick question here. It's more geared to us, but I got a question for you as it relates to my answer. So Kyle's asking, if I have a Roth IRA that is shorter than minimum investment, is it possible to mix Roth and cash into the shorter medium-term Ironton funds? So Kyle, let me think about how to answer that. So ultimately, you have to meet the minimum investment. It's $50,000. Usually, we have we've got manager discretion if we want to bring that down to $25,000. If that's your scenario, we can accommodate. But ultimately, you have to have the cash necessary in the fund or in your Roth IRA and satisfy that minimum investment in order to invest. Now, if you have, let's say you have $50,000 or $100,000 in your Roth, you're more than welcome to say put $50,000 into a medium-term fund, take $50,000 and put it into the short-term fund. Now, a question I would have for you, Jeff, if somebody were to do that, would that be set up as two separate investments in that IRA, or how would that be structured for an investor?
Yeah, so if you're investing in separate funds, think about the paperwork you're completing. You're going to fill out 2 different subscription agreements. Anytime you're filling out a subscription agreement, that's going to be a separate asset or a separate investment. So that would be 2 assets that you're holding in your self-directed account there.
Got it. Makes sense. And then Kyle, yeah, if you had to add on to that, which I think I might have missed, but let's say you had, 20,000 in a Roth IRA and you had 15,000 in cash, you can do an investment with Ironton. However, those would be treated as 2 separate investments because the IRA is the account holder or investment entity of that investment, and then your cash would be a separate one. Good question.
We do have a structure in IRA LLC, and it can be used to pool capital. So I do get this question as well from individuals trying to meet a certain minimum investment dollar amount. They might have money in a traditional IRA and a Roth IRA, or like you mentioned, Roth IRA in their cash account. Maybe it's them and their spouse, and they each have IRAs. There is a multi-member IRA LLC. Open up your separate self-directed IRAs, pool the capital into one LLC. Now the LLC could do the subscription to the investment. That might hit your minimum that you need at Ironton Capital, and you both get to share in the rate of return, or whatever those capital sources are, get to share in that rate of return.
Awesome.
So just going back to the investments here again, having your account at directed IRA going to open up all these different investment options. Investing, in a more traditional brokerage IRA, just limited. It's kind of like going to McDonald's and trying to order a chalupa. It's just not on their menu. So having your account with direct IRA is just going to open up those options and give you way more control. I talked about this one rule with investing with your IRA. If you guys are interested in the rules, obviously we have Matt's book. You can reach out and chat with me more. The main takeaway here is you cannot transact with your own IRA account. So if you are the general partner of a fund, you're probably not going to be able to invest your IRA in that fund. There's just a conflict of interest there. But if you're a limited partner, again, shouldn't be any conflict of interest and should be a viable investment for your retirement account.
Awesome.
We offer a number of different plans that you can self-direct. I'd say the ones on the left you probably all have heard of, traditional and Roth IRAs. We're huge proponents of the Roth IRA where it grows tax-free. So anyone that's interested in taking their traditional IRA funds, that money they haven't paid taxes on yet, that they've been deferring all these years, converting it over to Roth, we can chat about that in more detail. If you've ever heard, I make too much money, I can't have a Roth IRA, that is completely incorrect. You might have to jump through some additional hoops, but you can absolutely get money into a Roth environment, and we can talk about how that works. For all my self-employed individuals out there, we offer self-directed SEP IRAs and solo 401k plans. If you're self-employed or have a side hustle without employees, you really need to check out the solo 401k plan. It has a Roth component to it that can grow tax-free. It is an excellent retirement savings vehicle for those that are self-employed. And then I just want to mention these other 2 accounts that we custody as well: health savings accounts and Coverdell education savings accounts. Coverdell education savings account, you could build wealth tax-free to pay for your kids' education or your grandkids' education or your nieces and nephews' education. That can be an extremely powerful tool. We all know the price of education is going up. And then even your health savings account. If you qualify for a health savings account, probably limited to the investments you can make there. Investing in a short-term or mid-term fund that generates some capital appreciation, allows you to reinvest it, could be a great way to grow that health savings account to then help pay for future medical expenses. So don't discount those plans. Those can also be utilized for an investment in a private fund, just like we're talking about today. What are the main benefits of using the self-directed IRA? I think your example there about the tax treatment, whether you were selling the property and doing nothing, or if you were investing in the fund. Let's take capital gains taxes and just completely get rid of it in this scenario. Your IRA account or 401k, it's a tax exempt trust. So investing in this type of vehicle just allows you to, again, allow that growth to compound either tax deferred or potentially tax free in an account. So the tax savings is a huge benefit to using your retirement account. Especially if this is money that you don't need the liquidity, you don't need it personally. If this is long-term kind of investment dollars that you're utilizing, which most retirement plans are, a great way to invest the account. It's passive. You're, as the investor, the LP, you're not sourcing the deal. You're not developing the underlying investment strategy. The fund operator gets to handle all that administrative work for you. And you just get to collect returns on investment. And those returns can be somewhat predictable. Your IRA is going to collect returns based on the terms which are disclosed up front. Obviously, do your due diligence on the terms and the operator, but when you're investing in private funds with your retirement account, many clients like the predictability of the returns being deposited back in and being able to anticipate that. And then the final thing I'll just mention is diversification. If you're invested in real estate and in the market, you're diversified. But if you're invested wholly in the market, even though you have stocks, bonds, mutual funds, they're all correlated to the stock market. You're riding that roller coaster. Having some investments in private assets that aren't correlated to the market or interest rates, gives you some real true diversification. How are you going to personally benefit from this? You'll benefit when you take distributions after retirement age. So right now, that's legally 59 and a half years of age. You can defer all of this growth in your retirement account until then, and you can start taking distributions at that age. You don't have to take distributions until RMD age, which is 72, going up to 73, and then eventually 74. For traditional IRAs, Roth IRAs, no required minimum distribution. But
awesome.
Again, that's when you're going to personally benefit from all this growth, when you eventually start to distribute money out of the account and use it for personal reasons. How do we get started with the self-directed account? It's really 3 easy steps. We need to open an account, we need to get it funded, and then we need to invest the account. Opening the account can be done online. We got an online application, take you about 5 minutes to complete. If you're unsure of which account type or you want to discuss your personal situation, you can book a call with me. We can have that conversation and I can help you get started as well. But opening the account is very simple. The next step, we need to fund the account. This is the step that directed IRA doesn't control. So it can take a little bit of time. This age of Zelle, Venmo, Cash App, we're used to just moving money instantaneously. Unfortunately, retirement accounts, it seems like they're stuck in the 80s. Yes, it's 2026, but if you're rolling over a 401k, it's going to be a check sent through the mail. We're still faxing transfer requests to back offices. So it can take some time, and there's some nuance to this. That's where having a custodian like Directed IRA to help support you through this can be very helpful. You can also make contributions to your account. So if you haven't contributed to your IRA yet, you still qualify. Rather than investing that cash out of your checking or savings account, maybe it would be helpful to first contribute that money to a Roth IRA, then make your investments so that any of the returns you generate can be tax-free.
Awesome.
Time frame on this, I'd say transfers 5 to 7 business days. That's just moving from one IRA to another. Rollovers, they're going to mail a check, so probably about 2 to 3 weeks. Contributions, matter of a few business days, you can have funds in an account and then ready to deploy for an investment. And that's the fun part. That's the final step here is after this account is open and funded, let's go ahead and invest the account. Whenever you're investing with your self-directed account, you have to provide an authorization to us as custodian so we know where to send the capital. It's called the direction of investment form. And then we'll need a supporting document. If you're invested in a private fund, that'll be your subscription agreement. We'll get a copy of that, and then we'll use those documents to fund the investment. A key here is you and your IRA are not one and the same. So when I'm filling out a subscription agreement for my Roth IRA to invest, I have to use the proper vesting or titling. You'll see here this example at the bottom. I'm investing with my IRA. It's not Jeff Minnick subscribing. It would be Directed Trust Company for benefit of FBO, Jeff Minnick Roth IRA. Now, anyone that wants to get started with the self-directed account, feel free to scan this QR code. That'll take you to my calendar where we can book a call to help get started. You've also got my direct contact information here, my direct number, my email address. And as a special thank you, Nick, for having me on here, any of the Ironton Capital investors that create an account between now and the end of August, we're going to give you an additional promotion code discount here. We're going to give you $200 off your first year annual fee, just as a courtesy and thank you for being on the webinar, registering and watching this with us today. So I want to make sure that gets extended to anyone that wants to get started with directed IRA.
Awesome. Thanks, Jeff. What are some of the most common questions you get on your introduction calls with people wanting to open an account?
I would say a lot of them revolve around their current employer 401k plan. If you're a W-2 employee and you're working somewhere, you may not be eligible to roll over that 401k plan. Now, every company is different. They set up their own plan, their own rules. So it's worth looking into. But when I hear current employer plan, that kind of gives me the yellow light. We need to do a little more research and check on that. If it's an old employer, somebody you used to work for, you no longer work there, you're not participating in their plan, that's the green light. You can absolutely roll that money out of the plan into your own IRA, your own individual retirement arrangement, and start using it how you see fit. But those current employer plans, they do require just checking a little bit further to see, can you do an in-service rollover or no?
Gotcha. Understood. Hugh, can investments in the midterm be combined instead of new investment? A little bit confused on your question there, Hugh. If you want to maybe reword that a little bit, hopefully I answered your question, but you can continue adding to your position over time. If that doesn't answer your question, let me know and I'll give you a different answer. Then Robert, on the medium-term fund, is the money locked up for 1 year and then you can get money out at any time after that, or should you expect to commit to a second year after the first term? So the overall structure of the midterm fund is that it's going to be open until 2031. So June 2031. All the way up until then, the fund will distribute interest on your principal amount. And then once 2031 hits, there's a gradual payback of your principal in addition to interest payments until everything is paid back. Now, the 1 year lockup, that is only the commitment that you're held to. So if a year is up and you need liquidity, you can get that with a 3-month notice. Of course, if you want to just leave the money in there, you can continue to leave the money in there, continue earning interest on your principal. You can also continue adding to your position as you come into more liquidity. So we're very flexible. We want to, accommodate our investors as much as possible. Hopefully that answered your question, but if not, feel free to throw it in the chat and I'll expand upon my answer if necessary. If you guys have any questions for Jeff, feel free to send them over. We've got 20 minutes, so we've got plenty of time here. Let's keep this interactive, and this is your time to ask him any questions. Jeff, can you walk us through, if somebody wants to set up an investment in an alternative firm such as Ironton or any other firm, like what is the overall process that they need to go through from initiation of the investment all the way to funding the investment with that firm?
Yeah, great question. Happy to go through it. First thing is having your account open and funded, so completing those first 2 steps, you have capital to deploy. But then it would be working with the investment sponsor or the fund sponsor to obtain the subscription agreement or the offering documents. You have to complete that. If the fund is only being offered to accredited investors and you want to invest with your self-directed account, you are extending your accreditation to your IRA. So any investor questionnaire that you may receive there about being accredited, you answer that with your personal information. When it comes to the subscription agreement, kind of like we talked about earlier, you and your IRA account are not one and the same. So the subscription agreement, while you can still sign it on behalf of your IRA account, you want to use the proper vesting titling to reflect the IRA is subscribing. At Directed IRA, that would read Directed Trust Company, FBO for benefit of, your name, and then your account type. And then at Directed IRA, we also need authorization to send capital out of your IRA account to the bank account for the fund.
Mm-hmm.
So that's our direction of investment form's pretty simple. It's asking you what's the name of the investment, what's the dollar amount that's needed, and what's the bank account where the capital needs to be sent. By you signing off on that document, that's giving the authorization for us as custodian to do our work, which is to either send a check, an ACH, or a wire to the investment based on whatever you've selected. After that investment has been made, that becomes the asset that you're holding in your account. So just like buying a stock in place of cash, you now hold this private fund investment. And going forward, if there's any returns on that investment, if they're not being reinvested in the fund, those would be deposited back in your IRA account. Again, you didn't make the investment, your IRA did. So the returns have to go back to the IRA first. And that's what's keeping everything tax sheltered. All that activity is happening under the umbrella of your IRA.
Awesome. What's like the average time it takes to get through that whole process?
I would say if your investment documents are in good order, we process investments within 3 business days. But I'd say many directed IRA clients, they're accustomed to seeing 24 to 48 hour turnaround times.
Awesome. So that's great.
Your subscription agreement's filled out properly with the vesting titling. We have the direction of investment form. Your account's open. You have capital that's cleared, ready to deploy. You could see that investment process same day. So if there is any deadline, you can absolutely expedite, jump to the front of the line, pay an additional fee for that. But again, to avoid that, set up your account in advance, make your investment in advance, and just know it's really getting the paperwork correct. Once the T's are crossed, the I's are dotted, everything's in good order, we can fund the investment quickly. If there is something that's awry, our investment team is great to work with. They're going to work with you to get the corrections. They're going to make sure the sponsor's looped in on that. And we're going to do everything we can to get that paperwork in good order so we can fund the investment quickly. At the end of the day, we need a paper trail. We need to show what assets the account is holding. So we want to make sure that paperwork is correct and perfect before we go ahead and fund.
Awesome. Looks like we already have a good testimonial for you guys here. Rob has several accounts with Directed IRA. What I like best is a relationship with KKOS law firm. And if I ever have a question on the proper use of my STIRA, so looks like he highly recommends you guys. Thanks, Rob. Appreciate it.
Yeah, Rob, thanks for being a client. And the law firm he's talking about there, KKOS Lawyers, our co-founders, Matt Thornton and Mark Kohler, they're partners in that law firm. I know we talked about maybe setting up an IRA LLC for pooling capital. Directed IRA as custodian doesn't set up LLCs or do any entity formation. That's why it's really nice to have a relationship with the law firm KKOS Lawyers to provide that kind of ancillary service. They know how to set those up properly. They're also a full service tax and legal law firm, so they can help with trust formation and other tax and legal services. But they understand self-directed retirement accounts and self-directed IRA investor. So it's a really nice natural pairing that we have there.
Awesome. Hugh, I have 3 investments in midterm. Each is tracked separately. Will they be combined at some point in the future? Great question. So the reason that they're separate is because with each new investment, there's a separate interest calculation. And that is really specific for that first prorated quarter, because your first 2 investments, for example, if they're in for a full quarter, but then you add a 3rd investment, it needs to be tracked separately because that's going to have a different interest calculation. But once that first prorated quarter is through, it does show up as 3 separate investments in the investment portal because they have separate contribution dates. But for the purposes of the calculation, once that prorated quarter is through, for the purpose of the calculation, it's all calculated based on one combined investment. It still will always show as separate tranches within the investor portal. So hopefully that helps. Jeff, what else do you get? What are some things maybe we haven't asked about a self-directed IRA that is important to know for when somebody wants to set something up or make an investment in something, in an alternative investment, or even just to direct their own investments?
Yeah, I think when you're evaluating your self-directed IRA custodian, who do you want to set up an account with? Who do you want to work with?
Yeah.
They're self-directed IRAs. So you're kind of the captain of the ship. Your custodian's really the crew for hire. So you're really, making all the investment decisions. But, if this is the first time you're ever self-directing your retirement account, you may have some questions. You may need support. So I think it's important to work with a custodian that is not just knowledgeable on the rules and what you can and cannot do, but one that also is responsive and provides great customer service. That's something that Directed IRA, I think, excels at. We kind of hang our hat on that. Really, one of the reasons why I think Directed IRA came about was, our founders used to refer a lot of their law firm clients to our competitors, and they found some of the customer service was really lacking. When you're trying to get a deal done, we process within 3 business days, but if you can't get a response about your paperwork and whether or not your subscription agreement was received, and if you need any other, information to process your investment, it can be really frustrating. So I would definitely recommend, taking a look at your custodian, read their reviews, make sure that they provide good, prompt, responsive customer service. And then I think the other selling point really is that everyone's always looking at, especially nowadays, is what's the cost? What are the fees that are charged? One thing that I really love about our fee schedule is it's very straightforward and upfront. When you open your IRA account, you pay a $50 account establishment fee, and then you pay a flat annual fee of $495. We don't charge based on the value of your account. So if your account balance, were to grow, we're not going to charge you a higher fee. You're not being penalized for making good investments. That flat fee is going to cover holding up to 3 alternative assets. So if you were invested, let's say, in the short-term fund, the medium-term fund, that'd be 2 assets. You're not paying any additional fees. You can make a third investment, private or alternative investment, without incurring additional fees. The only other fee I would say you really want to be concerned with when working with Directed IRA is our investment processing fee. When you're ready to subscribe to a private fund, our team's going to review that subscription agreement, make sure it's correct, work with you to get any errors fixed, and then send out capital. So you'll pay a one-time $50 investment processing fee for that. Outside of that, your account's just collecting returns on investment, and you're not paying any additional fees unless you're making additional investments or maybe doing other transactions, taking distributions or transferring money back to your brokerage account, perhaps.
Awesome. Question from Hugh. Can we go back to the slide with the book, and then I'll address Cindy's question here. But let's go back to the book, and can you tell us how people can get their hands on that?
Yeah, so it's the Self-Directed IRA Handbook. The author is Matt Sorensen. He is the CEO of Directed IRA and a partner in the law firm of KKOS Lawyers. Again, he's really viewed as kind of the guru of the self-directed IRA industry and the leading expert. So Matt has made a career out of understanding and educating people about self-directed accounts. This book can be purchased on Amazon. I think it sells for $19.99. So you can pick it up pretty at a reasonable price there. And then he also sells it through his website. So mattsorensen.com. He's got an entire channel about just educating about how to build wealth and to protect it from taxes. So again, 2 great options, Amazon or mattsorensen.com.
Yeah, Joseph, great question. Why do we need it if we have Jeff to advise us?
Sometimes I'm busy. Sometimes I'm doing a webinar, so I'm not taking calls right now. Or sometimes it's the weekend. I do like to take a vacation once in a while, and I am off on the weekends. But no, the Self-Directed IRA Handbook, it's just a great guidebook to have. I know some people nerd out on the case law and everything that's cited in there. They want to take that extremely deep dive into understanding, the rules and the regulations and the different investment types. So I would say I am not an attorney. So if you need certain case law cited or something like that to back up, the rules for retirement investing, the book is going to be a great resource for it. But yeah, I always try to make myself available. If you guys have questions, investment ideas, use me as a resource. That's exactly what I'm here for.
Yeah, guys. And, we have some mutual clients, and there's a lot of people that are, starting to work with Directed IRA. Jeff's been a phenomenal resource. He's quick to respond. so far, Directed IRA has been a great partner for Ironton Capital, and we look forward to expanding that relationship. So don't hesitate to reach out to me, even if you have questions. And looks like Joseph, I'm on the calendar, so maybe you have an appointment booked already from the webinar. So that's awesome. Cindy, real quick. So what is the general term of the diversified fund project from start to finish? Is the calculated return on investment usually met? So we've made probably 100, rounding, but 100 individual investments across all of our national diversified funds. There's about 10 to 15 of them that are underperforming, not performing. There's probably about 10 to 15 that are currently overperforming relative to projections. And then everything in the middle is usually about, for the most part, on average, right on track. If you want to reach out and get a kind of a glimpse into the track record, I'm happy to send you some information. Nick, what was the short-term investment hold period? There's no required lockup in the short-term investment. We do ask for people to, have an expectation to at least be in the fund for 9 months. We don't want anybody to treat it, like it's an ATM machine. Additionally, if you do that through an IRA, you're probably going to incur a lot of fees that are going to negate any dividend distribution payments. So I would generally have a 9-month time horizon. But of course, we're not holding you to anything. If anything were to arise and you need that money unexpectedly, we can usually get that back pretty quickly. So it's a much faster liquidity redemption period than the medium-term income fund is. Good question. All right. Jeff, can we go to your contact page just in case anybody wants to reach out?
Sure.
Oh, here we go. Oh, wait, Rob, in business, invest in the short-term income fund. It's a good question. We should probably talk about that. Yeah, in general, we do have people that own businesses. If they've got any liquid capital that they've kind of got just sitting there that they know they might need, they're welcome to invest that in the short-term income fund to probably earn better than what you're earning at, Chase Bank or Huntington Bank. So yeah, in general, we can work with most accounts. There are some restrictions like the one that Jeff mentioned, like if you're with Fidelity. But for the most part, yeah, if you have a business account, maybe it's your own business and you got some liquid cash that the business has, you're welcome to invest through that entity into the short-term income fund. All right, guys. Well, really appreciate your time. It's almost 7 p.m. if you're on Mountain Time. Really appreciate you guys being here, taking the time out of your evening to learn more about how you can park your liquid cash, or in the case of this specific presentation, how you can park some of your cash in a self-directed IRA outside of your typical, portfolios like stock and bond and real estate. So really appreciate you guys joining us. Feel free to scan the QR code. If you're interested in setting up some time with Jeff, his contact information is right there. I also put my contact information up top. I'll throw that in here again. If you have any questions, feel free to reach out to us. We really look forward to, continue to partnering up with you all or starting the relationship. And thank you for your time.
Yeah, Nick, thanks for having me on as a guest. Thanks, everyone. Let me know.
Thanks, guys. Have a great evening.